This is Nightly Business Report with Tyler Matheson and Susie Garrett. Brought to you in part by
TheStreet.com, interactive financial multimedia tools for an ever-changing financial world. Our dividend stock advisor guides and helps generate income during a period of low interest rates. We are TheStreet.com.
Finding value, the S&P at a record, the Dow close to one, and the Nasdaq is closing in on 4,000. But with the indexes at lofty levels, can you still find value in this market? Proceed with caution? Could all this optimism derail the bull run? We have the 5 things market watchers say every investor should watch. And power shift. The oil and gas boom in North Dakota and Texas isn't just benefiting the heartland, it's also creating jobs in Philadelphia at a shipyard. We have all that and more tonight on Nightly Business Report for Friday, October 25th. Good evening, everyone. I'm Susie Garrett. Tyler's off tonight. More positive momentum on Wall Street today. The S&P 500 closed at another record high, and the major stock averages ended higher for the 3rd consecutive week. Now, 2 tech companies were the talk of the trading day. Amazon surged 10%, and shares of Microsoft shot up 6%. It was the biggest gainer in the Dow index. Investors bought up those stocks, reacting to their quarterly results that came out late yesterday that we told you about. Here's a look at today's closing numbers. The Dow rose 61 points, the Nasdaq added 14, closing at a 13-year high, and the S&P tacked on 7, closing at that new record, 1,759. So with the S&P at a new record and the Nasdaq closing in on 4,000, it may be getting tougher to find some real value in the stock market. But as Seema Modi found, there may still be some value plays out there.
It's getting tougher and tougher finding value in this market. But there are a couple of what experts say are deep value plays, beaten down names that are still pumping out earnings. First up, Joy Global, mining and equipment maker, which shares down about 9% this year. Analysts say it's trading at an attractive valuation in comparison to its peers in the industrial sector. Plus, the improving global economy is expected to result in more demand for industrial names. In the retail space, American Eagle down 25% over the past 3 months. Analysts have been cautious on this retailer due to its high promotional environment and low store traffic. That's what her earnings in Q2. Add to that a colder and wetter spring resulting in less demand for its summer wear. Although analysts say the teen retailer could benefit from the upcoming holiday shopping season. Switch focus to tech. IBM. Yes, it's been a tough couple of quarters for Big Blue. That's resulted in a beaten down share price. But income seekers are cheering its dividend yield of 2% and its plans to continue to find new growth opportunities. Within tech, it's a battle between the slow-growing tech names that yield steady earnings growth and new age internet names that are posting strong top-line growth. Skeptics say these high-flying internet names like Facebook and Google are trading at a rich valuation and might be too expensive. While the bulls say if you want growth, this is a place to invest.
I'm the value investor from 1999 that's here in 2013 saying that a good place to make money from a valuation and cash flow perspective is what we've more affectionately referred to as new tech over the last 4 or 5 years.
Whether it be industrials, retail, or tech, if the market continues to move higher, experts say it will be even more difficult to find these deep value plays. For Nightly Business Report, I'm Seema Modi.
Let's turn now to Stephen Wood to find out where he's finding good stock buys. He's Chief Market Strategist with Russell Investments. So, Stephen, nice to have you with us. Are you finding that stocks are just getting too expensive?
Well, I think in the U.S. market, we're seeing a fair valuation on the market. So when you look at the earnings, PE, so how much can you buy in earnings for what you're paying for stocks? I mean, it looks kind of fairly valued. It doesn't look overly expensive, but it certainly doesn't look overly cheap either. So from our perspective, if we confine ourselves to the U.S. market, I think we're seeing an environment where stock picking, stock selection is going to become more important. Valuations are always important, whether it's growth or value selections. But stocks right now, they don't look overly rich, but we think it's going to become more of a stock picker's game, an active management game, and picking those companies that not only have great earnings, but in this environment that can really drive revenue. So I think revenue is going to be far more important for stock performance going forward. Did you agree with what Seema just reported, that new tech is the place to find the good deals? Well, I think it's a part of it, and we would look at a multi-asset strategy. We're not only looking within tech, but energy, healthcare, the broad array of the best companies within equities, but also we're looking globally. So we want to understand our valuations more attractive in Europe and the United States, for example. So look at emerging markets, looking at Europe, and where can those really strong balance sheets, those revenue drivers, be had for a valuation discount. So I think we would look within equity space, but also look globally to see where the opportunities exist.
You sound very upbeat and positive, and I know there's a lot of positive feelings out there in the market, but aren't you a little bit nervous when you see even the Russell 2000 hit an intraday new record high during the day, S&P at a new record, stocks like Google, getting above $1,000. Doesn't this make you a little bit more cautious?
Well, we're always looking at what are the risks and the opportunities in the market. So we talk about this stuff every day, every week, all month long, all year long. So for us, this is nothing new. So when stocks pull back, we have the same similar conversation. But you're right, the Russell 2000 small cap stocks are right at an all-time high. The Russell 1000, which is large cap space, is at an all-time high as of today. So, but within that space, again, we don't see an over or stretched valuation. We just want to know what are the names that have better and stronger balance sheets. Because if you look at the earnings environment right now, you're kind of, right around market averages. But when markets tend to do well, people tend to bring up these concerns. But we would also look at Europe. We would look at emerging markets. We would look at commodity space, infrastructure, take a very multi-asset approach to this.
All right. Let me ask you this. I mean, it doesn't take much, as you know, to trip up this market. All we need is a negative economic report out of China or something like that everybody gets very nervous. So how should investors protect themselves as we have these rallies? Would you recommend sell into the rally, take your profits?
I think they need to take a very actively managed strategy. So rebalancing is a part of that, looking where valuations are richer, more attractive. So again, this globally diversified multi-asset strategy, it's not about one versus the other. It's about how do you combine them in a total portfolio. And I think if you look at what can trip us up, political risk, which we've been seeing a lot of recently, that could be an opportunity. And we would look at what happens in Washington. If the market were to pull back, that would be an opportunity. Military interventions tend to be opportunities as well. But I think perhaps most importantly, the Federal Reserve is going to keep interest rates very low for the foreseeable future. And that is going to be a natural wind underneath equities right now. So we're constructive. We understand there's going to be volatility, but going into 2014, again, globally diversified strategies make sense to us.
All right. Sounds good. Thank you so much, Stephen. Have a great weekend. Stephen Wood, Chief Market Strategist with Russell Investments. Well, despite the recent rise in the major averages that we've been talking about, some experts say they're seeing warning signs that the markets may be a little overheated. So is it time to adjust your portfolios and take some money off the table, or keep risking it, betting that stocks will go even higher? Dominic Chu takes a look.
Some investors are showing signs of worry, and they're looking at a number of different things. First, there's market sentiment. According to data from the American Association of Individual Investors, investors are not only the most optimistic they've been in 10 months, they're also the least pessimistic in the last 21 months. If investors are too bullish, that could be a bad sign. Second, is the stock market too richly valued? Many say no, but the S&P 500 currently trades at 16.5 times earnings. In other words, you'll pay $16.50 in stock price for every dollar of earnings that a company makes. That's higher than average. Third, momentum is slowing down. Stocks that have rocketed higher, like electric car maker Tesla and online media company Netflix, are losing steam. Fourth, some stocks are reaching record highs and surpassing $1,000 a share. Think Google and Priceline.com. That could be a warning sign. And fifth, margin debt is at a record high. In other words, investors are borrowing record amounts of money to buy stocks. Veteran investor Byron Ween says to stay alert.
You don't have an enormously overpriced market. You have a market that's vulnerable to a correction at any time. There's a fair amount of speculation in the market.
On the other hand, some think the bull run continues.
Although there are some warning signs out there, we think that 2014 is going to allow for the market to really expand its multiple, and you're going to see earnings pick up and revenue pick up, and that's going to push the market higher in our opinion.
Now, it's not to say anyone really knows where the market is headed, but some experts are definitely moving ahead with some caution. For Nightly Business Report, I'm Dominic Chu.
We begin Market Focus tonight with some positive results from United Parcel Service. The world's largest package delivery company beat estimates by a penny and reported revenue that matched forecasts. Growth in online retailing and a boost in European exports helped UPS deliver solid results. Shares rose more than 1% to $95.61. Growth overseas, cost cuts, and lower tax rates are helping Procter & Gamble. P&G posted profits that were in line with estimates and revenue slightly above expectations. The maker of Tide and Pampers also reconfirmed its positive forecast for this year. But signs of growth didn't help lift the stock. Shares were down a fraction to $80 a share. Sherwin-Williams posted a rise in earnings helped by strong sales at its paint stores. The company has benefited from a housing rebound, bolstering its retail business and helping offset a rise in raw material costs. Investors brushed off that aspect, sending the stock up more than 4% to $195 and change. And a jump in sales helped Callaway Golf beat earnings expectations and boost its outlook. The CEO said the golf equipment maker gained market share in many major markets, and better weather in Europe and the Americas led to more golf rounds being played. Shares surged almost 20% to $8.70. And still ahead on the program, remember the mortgage-backed security, the bond made famous by the housing crash? Well, now there's a new one being offered that's backed by rental homes. But will this time around be different? JP Morgan reaching a $5 billion settlement with the Federal Housing Finance Agency. The deal resolves claims that it misled Fannie Mae and Freddie Mac about risky mortgage securities sold before the housing market collapse. A broader deal with the Justice Department is still being negotiated. Well, it pays for an airline to take off on time. United Airlines just received the largest fine ever by the federal government for leaving passengers stranded on the tarmac. The Department of Transportation fined United more than $1 million for keeping passengers aboard 13 flights during thunderstorms at Chicago's O'Hare Airport in July of last year. Federal rules say that planes carrying more than 30 passengers are prohibited from keeping them on the tarmac for more than 3 hours without offering them the chance to get off the plane. Wall Street regulators have put a cap on claims that the Nasdaq exchange will have to pay out for its botched initial public stock offering of Facebook shares last year. It's $41.6 million. That figure was calculated by Wall Street's watchdog FINRA, the Financial Industry Regulatory Authority. The amount is much less than the $62 million that Nasdaq had set aside to repay brokerages for lost money. So you've heard of mortgage-backed securities and their role in the housing market collapse. Now there's something called rental-backed securities. They're bonds backed by single-family rental homes. This new investment vehicle may be hitting the market next week. Diana Olick has the details.
When housing came crashing down and millions of Americans lost their homes, large-scale investors crept into the nation's neighborhoods. They bought thousands of foreclosures, not to flip, but to rehab and rent. They are still hungry for more, but need more cash.
When we look at this asset class, clearly it's been a good investment for these large companies that have put their equity at stake, and now they're looking to gain some either exchange this leverage for another, or take out some just brand new leverage.
Sitting on a portfolio of close to 40,000 homes, Blackstone, the largest player in this new game, will offer bonds backed by its homes. It's just like a mortgage-backed security, but instead of revenue coming from monthly mortgage payments, it comes from rent. $500 million worth of these bonds will be offered as early as next week, according to sources. JP Morgan, Credit Suisse, and Deutsche Bank will market the bonds, which represent a few thousand homes. Potential investors are already asking a lot of questions.
We want to look at the operations. This is again, it's a new asset class, and so we want to make sure that the sponsor that has invested the equity is going to be able to collect rents, re-rent these properties in a fairly short time period and basically be very efficient about operations.
Investors also want to know how committed the sponsors are to this new asset class. Will they sell the homes to other investors or hold on for the long haul? And where are these homes? Are they in good local markets with good economies and good jobs? In other words, will the tenants be able to keep paying the rent?
I do believe securitization serves a great purpose if done well. But I think it takes a little more development coming.
With investors pouring $20 billion into single-family rentals in just the past few years, there is no doubt Wall Street will look to cash in. The hope is they will also look back at the last run on a clever new investment product and learn from their many mistakes. For Nightly Business Report, I'm Diana Olick in Washington.
For more on the potential risks and rewards of bonds backed by single-family rental homes, head to our website, nbr.com. Our market monitor tonight says now is not the time to plow large sums of new money into stocks. He's David Katz, Chief Investment Officer at Matrix Asset Advisors. David, you sound pretty cautious. Do you buy into what Dominic Chu was reporting earlier in our program about the warning signs that are out there in the markets?
Well, we don't think there are warning signs per se. We've been very bullish all year. We've been upbeat about the market. We've got a lot of the returns. With stocks up 25%, we don't think now is the time to get renewed optimism. Now's not the time to be doubling down your bets. Our best guess is stocks are going to end the year higher. It's going to be a good fourth quarter. We're upbeat about next year. But if you're looking to put new money to work, we would put it to work during sell-offs when the market is getting spooked by something. Like the last few weeks, you had a 4 or 5% sell-off. We would buy into that, and we wouldn't be chasing the rallies.
All right, you have a couple of stocks that you're recommending. Maybe they're the ones that you buy when the market dips down a little bit. Let's start with the first one, Capital One Financial. Why do you like this one?
Well, the stocks that we're going to talk about generally haven't done as well as the overall market, so we're pretty comfortable buying them here. Capital One has underperformed the overall financial group and credit card group in the last year in terms of stock performance, but their business has actually been doing much, much better. Credit trends have been very good. It sells at under 10 times earnings, and management has made a renewed commitment to shareholders to return dollars to shareholders through buybacks, through a higher dividend. We think they're going to be very focused on shareholder value, and it's one of the cheapest credit card and financials out there in very good shape.
And your next one sounds like it sort of fits into that same formula, Cisco Systems, which has slipped recently, although it's been up for the year. It's now trading at $22. Why do you like Cisco?
Well, Cisco has done nicely for the year, but they've given back a lot in the last few weeks. The sentiment has turned from positive to very negative. Right now, the stock sells at about 10.5 times earnings, pays about a 3% dividend yield. We think they have a good long-term future. The next quarter might be a little bit difficult, but at 10, 11 times earnings with nice earnings growth over the next 2 to 3 years, we think it's a good company, very good entry point. Our target is in the high 20s. We think on the downside, maybe you have about $20. So you have about $2 of downside, $8 to $10 of upside. We think that's a very good risk reward.
All right, let's talk a little bit about McDonald's, because investors were a little disappointed in their earnings report, quarterly numbers that came out this week. It got as high as $103 just a few months ago. Why do you like McDonald's?
Well, in fact, if you listen to that investor call, the analysts were pretty hostile toward management. The company beat earnings by a penny, but their revenues were a little bit light. They gave a lackluster outlook in terms of same-store sales trends. Having said all that, they pay a 3.5% dividend. They sell at 15.5 times earnings. We think in a better global economy, a better European economy, a pickup in the United States, business is going to pick up. And at this price, it's a very good way to play a market that has done exceptionally well this year. This is one that hasn't participated. If the market sells off, McDonald's should hold up real well, and we think should make pretty good money for you.
All right. One more, Qualcomm, another tech stock. What's the story here?
Qualcomm is a play on the new technology. Their wireless devices, they provide the guts to phones and to iPads, to wireless phones and to iPads. It sells at about 15 times earnings. Management is very focused on enhancing shareholder value. They're paying more and more out in terms of a dividend, buying stock back. It's at a very good price. We're indifferent whether Apple wins the game or Samsung wins. Qualcomm is providing chips to both of them.
To both of them. And it was up quite a bit today, $68. Do you have a target on it?
Our target's in the low 80s, but we think longer term it even can do better than that.
All right. Any disclosures, David, on any of these stocks?
We own all of those stocks. We continue to buy all of those stocks.
All right. Fair enough. Thanks so much, David. Have a great weekend.
Great to be here.
David Katz, Chief Investment Officer at Matrix Asset Advisors. And coming up, as energy prices fall, will American consumers spend more just in time for the holidays? The White House promised today the nation's troubled health insurance website will be repaired by the end of November. Speaking for the first time since his appointment earlier this week, the troubleshooter assigned to fix the website had this to say.
By the end of November, the vast majority of consumers will be able to successfully and smoothly enroll through healthcare.gov. The issues with healthcare.gov today will be resolved, and the system will operate as it's designed to.
Also today, the Obama administration said it hired a new general contractor and technology expert to manage the overall repair effort. It's Quality Software Services. This is a unit of United Health Group, the health insurer. Well, some bad news for some furloughed government workers who applied for and got jobless benefits during the 16-day federal shutdown. The Labor Department says that since Congress approved back pay for those furloughed employees, that means they were not unemployed and that individual states have to get them to return any unemployment checks they received. Oil prices rose today, closing at $97.85 a barrel, but they still managed to decline for 3 straight weeks. And with the trend in energy prices moving lower, Jackie DeAngelis takes a look at what that means for gas prices and consumer spending.
Lower energy costs are looking like an early holiday gift for U.S. consumers. You've probably noticed the gas prices are down a lot. AAA says the national average is $3.31 a gallon, down 13 cents in a month, and down from this year's high of $3.74 in February. The question, how low can we go?
I think at the pump, you could see $3.10. And if you remember last year, we were coming out of a summer where the supplies were very tight because there were a lot of refinery problems. And then we had Sandy coming into the picture.
Others are targeting $3.15 to $3.20. Why? Crude oil is comfortably below the $100 a barrel mark, down almost 11.5% from its 52-week high. Longer term, rising U.S. oil production is making us less dependent on foreign supplies, which should drive prices even lower.
We are importing about 8 or 9 million barrels a day. That we can eventually absorb with our own production if our production gets high enough. So we have plenty of room. We just crowd those people out of the market.
One rule of thumb here, every time the price of crude drops $1, the price of gas comes down about 2.25 cents. Not bad, but the current levels won't get the experts thinking that U.S. consumers are about to change their spending habits.
They're grumpy and they're like sort of the old man, that's returning a bowl of soup at the deli. They're not going to drive more. They're not going to take more vacations.
Still, most seem to agree every little bit counts.
Yeah, when it's cheaper, we spend more.
Even a little bit makes a big difference in our pockets.
And as temperatures fall outside, it's looking like it may be cheaper to keep things warm inside. Natural gas is down roughly 11% in the last 6 months, and heating oil has seen a drop of 6% in 2 months.
Oh, it'd be great. Do more shopping.
Not a bad thing with the holiday shopping season about to begin. For Nightly Business Report, I'm Jackie DeAngelis.
And finally tonight, the dramatic rise in production of shale oil and natural gas in the nation's west is now benefiting companies all the way across the country. Brian Sullivan has the story from the city of brotherly love.
The American oil and gas boom is not just benefiting Texas and North Dakota. It's also bringing big business to Philadelphia. Really big business, because the men and women of the Aker Philadelphia shipyard are building that. The Liberty Bay, a huge new tanker set for duty transporting oil up and down the West Coast for a subsidiary of ExxonMobil. Shipyard manager John Bond lays out just how big the ship really is.
The actual oil capacity, you're looking at about 126,000 cubic meters. And to put that a little bit more into perspective for maybe people at home would be around 33 million gallons of crude oil and approximately 790,000 barrels of oil.
Aker Philadelphia is a subsidiary of a Norwegian company, but the rest of the story is mostly homegrown. The Jones Act law requires any ship transporting goods, including oil, within America to be built in America. And much of the steel even comes from American steel mills. Like many industries, shipbuilding fell on hard times during the recession. But the energy boom has helped the Aker shipyard nearly triple employment in the last 2 years to more than 1,000 workers.
It's a game changer for our industry. The increase in shale oil production in the United States has increased dramatically, and ships have played an increasing important role to move that oil to refineries along our nation's coast.
And these jobs will last for a while. The shipyard has a contract to build 6 tankers. The Liberty Bay is the first, and each ship can cost as much as $200 million and take up to a year to build. So while the actual oil and gas being drilled is thousands of miles away, the workers here at the shipyard say the impact is being felt much closer to their home. For Nightly Business Report in Philadelphia, I'm Brian Sullivan.
And you can read more about shipbuilding in Philadelphia and how it's benefiting from the nation's oil and gas boom by heading to our website, nbr.com. Well, that's it for us. Nightly Business Report for tonight. I'm Susie Garup. Tyler Matheson will be back on Monday with me. Thanks for watching and have a great weekend.
Nightly Business Report has been brought to you by
TheStreet.com, interactive financial multimedia tools for an ever-changing financial world. Our dividend stock advisor guides and helps generate income during a period of low interest rates. We are TheStreet.com.
I'm Susie Garrett with a Nightly Business Report news brief. Stocks ended higher today and higher for the third consecutive week, following another round of strong earnings reports from Microsoft, UPS, Procter & Gamble, and more. The Dow rose 61 points, the Nasdaq was up 14, and the S&P added 7 points, closing at a new record high. Wall Street regulators have capped claims against the Nasdaq exchange for its botched initial public offering of Facebook shares last year at $41.6 million. Furloughed government workers who received jobless benefits during the 16-day shutdown have to return the money. And United Airlines was fined $1.1 million by the government for stranding hundreds of passengers on a Chicago tarmac during a thunderstorm last year. Be sure to tune into Nightly Business Report right here on your public television station.